For questions concerning this content, please don't hesitate to contact me at kenya@futureandfinance.com or log on to my blog, https://www.futureandfinance.com. Last time on Automate. For 4 decades, purchasing power has remained the same due to inflation, and despite the salary increases enjoyed by some Americans, purchasing power is still the equivalent of a salary that was earned 40 years ago. Ask if an emergency were to arise, can it be paid using reserves within your savings? An alarming number of Americans do not know what they would do when or if faced with a crisis. Purchasing power is still the equivalent of a salary that was earned 40 years ago. With 39% of Americans not having enough to cover a $400 crisis and only 39% with $1,000 to cover an emergency, what do you do? The answer may be to automate your savings as best as possible. I have personally automated mine using a life insurance policy and the 30-day recurring cycle to automatically debit payments, which over the course of time earns interest. The interest that I enjoy is higher than if I were to save and maintain reserves in a savings account. It has to be an amount that is manageable from month to month, or 30-day billing cycle to 30-day billing cycle. Coupled with the savings component of the policy, I am able to pass on a death benefit to beneficiaries, which should help in hopes of offsetting inflation to the next generation. Hypothetically speaking, the traditional underlying strategy for savings throughout the decades went something like this. In your 20s, put 15 to 20% of income aside for savings. The goal was to have at minimum 1 year of annual salary in savings. The second part of that traditional strategy was to have 2 years of annual salary in savings by age 35. While enjoying the years beyond age 40, the goal was to have 3 times the amount of an annual salary. By now, I'm sure you get the picture. If you are listening to this or reading this and are able to use this traditional strategy, more power to you. The next step would be diversification. For many, this is not the case and is unattainable. Many people are living from paycheck to paycheck. Please keep in mind that banks do not have a fiduciary responsibility toward their account holders, so they have little to no interest in encouraging savings. They gain with fees, surcharges, and products, which earn them billions annually. So for those just starting out, try automating $50 a paycheck. Using a set it, forget it philosophy, a new strategy is born. Retailers refer to this as decision fatigue, when a customer has difficulty making another decision due to another being considered a new decision. Make shortcomings work in your favor instead of others. Turn your weaknesses into strengths. Many of these features are built into modern-day bank accounts, and it also serves as a means to monitor cash flow. Another way is by using roundup apps. With roundup apps, everyday purchases are rounded up to even numbers, and the change is deposited into a savings account. For example, if you purchase 2 slices of pizza and a drink for $7.50, the application would use $8 for the purchase, depositing 50 cents into savings. For those who use their smartphone apps for payments, this may serve as an attractive alternative. Other lifestyle changes are big as well. Automobile loans, gym memberships, smartphone financing, or whatever is financed over a span of time. When the term is settled, whatever was set using automatic payments would then be reconfigured to deposit into savings. It's maintaining a lifestyle decision-wise philosophy rather than remaining a habitual consumer. A person's lifestyle is identical to when money was being withdrawn. The difference now is that the amount that was once deposited to another's account is now coming back to you.